Welcome to Money Hangout once again. Every week we bring something of interest to you or a burning question. Try and answer your questions and also help you understand mutual funds better. This is brought to you by Birla Sun Life Mutual Fund and Value Research. Today we are going to talk about how to build a winning portfolio. The IPL season is on. We are all passionate about cricket. There are lessons from cricket which you can take a cue from, take inspiration from, and implement it in your portfolio. That makes it little easier for you to understand. As in cricket, it's important to have a great team and great and a great plan, and that is very valid for your investments as well. Achieving your financial goals requires a very clear plan, and if you don't fill your portfolio with great components, if you just fill your, unlike cricket, if you just have great bowlers only, it won't work. If you have just great batsmen, it won't work. Likewise, in your investments, if you, and we have seen it in the past that investors portfolio are dominated by entirely dominated by PPAF or fixed income, or our belief in fixed income. Maybe fixed income is important. It is important, but how much? And without completeness, you will not achieve your goal. So having great players, having a plan will put things in perspective. And I'll just try and help you understand how to go about doing it. You need a right team. You need a great team, and the great team should be made up of something which is core. The people who will be the foundation of your investments over time. So the core, should be consistent, reliable investments or players, and that I think is for the long run. You should have the large cap funds, the balanced funds that should make up for a meaningful part of your portfolio or a sizable part of your portfolio, and that should be nearly 2/3 or 3/4 of your portfolio should be in such funds, so that you can depend on that, and you can be confident that your goals will be achieved and things will be taken care of. Things will automatically be taken care of with that component of your portfolio. And then there should be supplementary part to the portfolio. You should have 2-3 hard hitters, or you should have some component of hard hitters, and that can be achieved, that those are the multi caps or the thematics or the small cap funds that you should have. One, it is interesting. The other is that it can cause a heartburn, so it should not be a very sizable part of your portfolio. And having 20-30% of your portfolio in that should take care of that need, and that is all that you need. Of course, you also need some nice fielders, and that component I am referring to as the people who your income component, or the need that you will have a short term need, and that is something which should be planned beforehand. And no part of your money which you need in 2-3 years should be invested in equity or equity linked investments. And if it is a non negotiable goal, you need the money exactly after 2 years and precisely the amount you are aware of, that is the money which should be in fixed income. It should be and it should not be dependent on the market. Then to keep things simple, if you don't want to do these things yourself, maybe you need the all-rounders. It could be a great team if it is dominated by all-rounders who are decent batsmen and decent bowlers, and a good team is made up of that. If you are a small investor getting started, and you have never invested in the market, maybe if you are likely to pay taxes, do it only with ELSS funds. If that is the maximum that you can save in a year, 1.5 lakh rupees, I think you can achieve that. If you are not a taxpayer, get started with a balanced fund. This is an all-rounder which will take care of things. It will help you stay on course. You are unlikely to be disappointed. One or the two will do well, and you will be taken care of. So these are, you can make up for these things, for simplicity, these two things, plus you get the tax break. So this is one part which you should work very hard on. Then an unfailing game plan. This is something where you need to really make use of the power play. Power play in this context, you will think that I am telling you that when you have to get opportunistic. No, that is not the way to go about it. The power play in investment comes only with time. The magic of compounding works only when your money is invested for a long period of time. And if you start little early, the the power plays out, and that's the most powerful thing that can drive your portfolio. Let me just cite you an example. 1 lakh rupee invested at 12% will become 30 lakh in 30 years, but delay it by 5 years and it will not be 30 lakhs. It will just be 17 lakh in 25 years. So that initial advantage, the power play that you get by getting started early, use it to your advantage. It will come in very handy. And this is making sure that the 5 years, if you don't invest, the kind of opportunity loss that you don't even realize sometime how injurious it could be for your long-term well-being. And make sure that the singles are important. That is another lesson which every investor should make sure that many a times we are not in a situation, or we think that we can't save, our consumption need or our spending needs are just too much. Make sure that in the worst of times you are investing a little bit, howsoever small it be, because all those amounts, the singles matter in the end. The power of compounding will work even on that money, and making sure that your habit of saving and investment continues is crucial. So these are the lessons which you should take from our what we love watching, which is cricket, and in this IPL season, take inspiration, get going.
Thank you, Dhiren. We'll now move to the questions that we've received today. This first one comes from Ashish. He asks if we can expect mutual funds to generate alpha when there is so much liquidity flowing into them.
I would say that alpha affects even the benchmark. The performance is getting affected by benchmark too. Affects the benchmark too. The liquidity, the liquidity that we see is finding its way even into the benchmark. So alpha is relative to benchmark and the ability of a fund manager to add greater value in relation to the risk that he's assuming. And I think there are fund managers who on a full market cycle have been able to add that, generate significant alpha. And I would say that don't get distracted by this hypothesis. There is a possibility, for markets to do well, we need both. Companies should do well, and then investors should be finding, investors' money should be pouring in the market as well. Investors' money is definitely pouring, and we have seen a big qualitative shift of a fairly defining kind, which we witness in our market right now. Money coming from all over and all kind of investors who were never very regular. So undoubtedly, this will have a bearing. But at the same time, I would say that for individual investor, they should just be onto an investment plan. They should be on an investment plan for the long run. And even if fund managers don't generate very high alpha, if you are able to ride on the economic boom, even that should be good enough for investors. I think the crucial lesson to learn for investors is not deriving great alpha, but making sure that we are beating inflation, we are riding an economic boom if it comes our way, and we are keeping away from the duds, we are keeping away from the landmines that can happen in the market, companies which are of a questionable kind. And I think by having a methodical plan, by doing some basic filtering, an investor can achieve all that.
Next up, Mahesh, who is retired, wants to withdraw 6% of his fund value annually from his portfolio of equity and balance funds. He wants to know if his SWP frequency should be quarterly, monthly, or yearly.
One is that if he has frozen about this 6%, I don't. I think he should work towards, for the money to be. He should be a little flexible about it. When the markets do well, he should withdraw 6%. When markets have not done well in the recent past, then it should be little lower. It should be 4%, and he should increase it to 7% if markets have done well in the recent past. Why I am saying so? Because after markets have not done well, your capital goes down, and when you are withdrawing the money on on a capital which has gone down in value, your 4%, 4% of what? If it is 4%, 6% on a continuous basis, that is fine. Will you be reviewing this 6% every year? Then it's okay. Then what periodicity you should take the money out? It entirely depends on your need. If you can, and if you can do with an annual withdrawal 1 year later, do it with annual withdrawal. Or if you can manage with 6 monthly withdrawal, and if your need is to actually do a monthly withdrawal or a quarterly withdrawal, then I think so it should be need based, and make sure that you are withdrawing as less as possible, and then revise it 3 years from now. If the investment value goes up, and then 6% could be more than enough. If your income need is not rising, so review your withdrawal rate. Make sure that you are not withdrawing substantially after the markets have not done well. Make sure that and you are withdrawing adequately to fulfill your needs and not exceeding 6-7%. And this, I think, on a long term basis will make sure that your income needs are met, as well as your capital will be protected in from value depletion.
Moving on, Ketan asks, how can he calculate the performance of his mutual fund when there are ongoing transactions in it and last year's value is also carried forward to this year?
Oh, you should set up his portfolio at Value Research Online, and he will get the return on his investments, and then he can compare, because what we do is, depending on calculating return on your investment when you are doing periodic investment gets complicated. So when you set up this portfolio here, and there are easy ways of doing it. You can go to CAMS or Carvi's website, get a consolidated account statement. Consolidated account statement, get the transaction statement and upload it on our website. All your investments will be, you don't have to manually type them, you don't have to manually input them. And once you have done that, we will give you a return, depending on your periodic investments and periodic withdrawal. A return number, which is the internal rate of return for all your specific investment, and then you can compare it. And if you want to look at the annual return, go to the capital gains tax view of the portfolio. So you will see that every year how much return you got from all your specific return or all your specific investment. All the return has 3 components, and you can see a breakup of that. Many a times you get some return in the form of a dividend. You also realize a part of your investments. So all these cash flows, inflows as well as outflows, are factored in for computing this internal rate of return. You have done your SIP, then you took some money out, and you got some dividend in between. All these things will be factored, and you can compare that return. And so I think Value Research Online is the best way for every individual investor to compute his return and look at how his investments are doing.
This next one comes from Bala Gopal. He says he made the mistake of sticking to FDs and PPF in the past. He is now starting to invest in mutual funds and stocks. He wants to know what should be the best combination of assets for him.
Best combination, if we look at the hierarchy of investment in terms of purity, if you are investing for the long run, then you have to invest in stocks. Then there are different ways of investing in stock. You can invest in stocks directly. You can invest in an index fund. You can entrust your money to the fund manager, or you can invest, and all these have different merits. Or you can invest in a balanced fund where all your money is substantially invested in equity. So these are your options of investing in equity. Now it all depends on your skill, your interest, and the time that you have. I think for most individual investors who are not used to market, and somebody who has invested only in fixed income in the past, I think investing in stock is a very dangerous territory, because our emotions are against us. We are not experienced, and then the knowledge and skill and understanding. If you do, and the only thing which works in stock market in the long run is buying some great companies and watch it grow, and have the patience and temperament to do that. So it sounds very easy, but it is very hard, because some great companies turn out to be bad companies if you buy them at extremely high values, and some not so great companies also turn into great companies. Some great companies turn into not so great companies. So everything is changing. the outlook changes. So it gets very subjective, and market on top of it is very volatile. Every morning at 9:30, so many people, 5 TV channels tell you how to, what to do, what not to do. So you get a very different, wrong impression of the market, and it's a very difficult profession. It's a difficult thing for you to do. So you entrust your money to a fund manager. If you don't know how to choose a fund manager, your option is index fund. The next option is, choosing a actively managed fund, where you entrust your money to a fund manager and he is investing your money depending on the portfolio. And if you're a first time investor, think of it as a balanced fund. It is a steady way of seeking growth. You want you to grow your money, but you don't want the extreme volatility of the market. So 25-30% money in fixed income provides it the stability. So these are your options. Choose one of the best suited for you. And I would urge you to, maybe if you all these options, maybe you can progress from one to another. You can start with a balanced fund, go to an actively managed fund manager, and then, and give 3-4 years time to each of it. Start with a balanced fund, remain invested, or do your SIPs for next 3 years. Then go to an equity fund, and during these 6 years, try and learn about companies as much as you can. Try to read some balance sheet. Try and make yourself aware of it. Understand about markets, what works, what doesn't work, how other investors have done, and never speculate. If you're and don't take tips. Don't make your investment lifetime savings on which crucial financial goals depend, based on something which is flimsy, which is based on somebody whom you can't track down tomorrow.
Next up, Govind asks if there is a bubble in bonds and whether gilt funds are safer than short term bond funds.
I don't know if there is a big bubble in bonds, but one thing important which every investor should understand, that the bond market bubbles are still centered around a intrinsic value, because unlike equity, where there is a possibility that bubble can build up, and bubble can build up to a point where something worth 20 rupee can be trading at 100 rupee. This kind of bubble doesn't get created in fixed income, because everything is rooted. Because there are three things which is, you definitely know about bonds. You know who the issuer is, so you know about the credit quality. If it is Government of India bond, you know that that possibility is ruled out. Then you have the second thing, which is how long the, how, when the bond will mature. So you know that this 7 years is still outstanding. If it was a 15-year bond, it has traveled, it has spent, 8 years have gone by, then you are left with 7 years. I'm just giving you an example. And you also know that what is the coupon on this bond. If you hold this bond for the remaining life of its currency, then how much return you will get on a annual basis. And the fourth thing which you can compare it with is that what is the prevailing interest rate, and whether the old investment, the coupon on this bond, is it more or less than the current. And that is how the bond prices get adjusted to. And so I would say that big bubbles don't generally get created, but yes, in the short run, if we are expecting that interest rates will go down, then investors bid up the prices of these bonds. So there could be a small bubble. There may not be a small bubble, just in case, because this RBI has been surprising us. And all the understanding of bubble is entirely a function of what RBI does, which none of us know. And we have also been wrong. So don't guess that. And on a full market cycle, I think though all those things don't matter. If you are a long-term investor in bonds, then all those things do cancel out, and we find that, on a long-term holding period, even the gilt funds or even some of the bond funds have been able to generate little more, or sometimes reasonably more, than the deposits.
Next up, Ambika says she has a mixture of large, mid, and small cap funds, but with the market at these levels, should she switch to balanced funds, Thiren?
Normally one should not do such a if you have all the time on your side, if you are investing for next 10 years, and if you can stick to this plan, maybe the small and mid caps will do very well. But it is also a matter of what your temperament is. Will you be okay If your investment goes down in value by 35%, if all the investments today that you have made is worth a lakh of rupees, in next 3 months, if it becomes 65,000 rupees, and if you'll be extremely upset, disappointed, and you will stop investing further, and you will repent your decision to invest, maybe you should consider moving to a balanced fund. But I would say that it is entirely, one should normally start with a balanced fund, stay there. Uh, your ability to withstand market volatility or decline in value in the short run, is it also a reasonable matter of your experience in the market? Somebody who has witnessed 2008 and seen the market bounce back thereafter will look at big declines differently. If you are a new investor, you have made a lot of money and you are happy with the return that you have generated, and maybe it's not a bad idea. But generally speaking, you should have a plan before you get started and stick to that plan irrespective of the state of the market. In fact, if you are a continuous investor, if you are a regular investor, maybe the bad times are a great time for investing in the more volatile asset classes, because that is a time when you are able to buy things cheap.
Next up, Rajiv says he has inherited rupees 20 lakh from his parents, but he's still a student, and he asks how can he invest this money to generate monthly income.
Uh, First and foremost, it's important to know how much income requirement he has, and depending on that, he should consider doing that. There are two ways of approaching this goal. One is that if his income requirement is just about 5%, or he can do with 5,000 rupee monthly income, he should keep 60,000 rupee in a debt fund and invest rest of the money in a fairly aggressive way, which means just investing 60,000 rupees of this in a fixed income fund and doing a systematic withdrawal plan of 5,000 rupees a month will make sure. And this is a very small sum. It's a very small component of his total corpus, and rest of his money can actually grow. If he wants to be a little more conservative about this, then maybe he should invest 1.5 lakh rupees for next 3 years and invest all the money, the remaining 18.5 lakh rupees, in a balanced fund. Investing the money in the balanced fund should also be spread over a period of time, because it's a very important money. And he should eliminate the possibility of catching a market high, and he should average his investment. So he should do his SIP over a period of 15 to 18 months, and so he will be assured of this. But first and foremost, he should decide his income requirement, and then we will be able to tell him a more accurate. But broadly, I have said that what I'm telling is that this is one way of doing it. The other way of doing it is investing all of it in a balanced fund or a MIP and doing a periodic withdrawal, depending on the negotiability of the deal, of the income, and his needs. He should make sure that when he is investing very heavily into, when it is a growth-oriented investment from which he is doing a periodic withdrawal, he should withdraw less periodically, and his withdrawal rate should be very low. Generally speaking, in the worst of times, a 4% withdrawal rate, make sure that your 4% withdrawal rate, make sure that you never eat your capital. On top of it, your capital is protected in value, which means that your capital will rise with inflation, so your income rises as well. So if you are taking 2 lakh, if you have 20 lakh rupees and if you are taking 4% of that, in 3 years time, if by virtue of inflation, or your investment value will go up, and based on the higher investment value, the 4% will also be higher. So your ability to revise your income with such a portfolio is very high.
Next up, Saket asks what percentage of his salary per month should be invested in mutual funds.
I'm not the best person to answer this, and you are. Uh, he should try and save as much as possible, because this is not a matter of an opinion. This is a matter of your consumption. This is a matter of your scale of income. So try and save as much as possible, and I can tell you about what to do with that saving. If you can save 100%, if you are living with your parents and you have no pocket expenses, if it's a possibility, your investments can actually do wonders for you. and because in the early stages of our life, when we invest, that money will remain invested for next 30, 35, 40 years. And that is when, when you'll realize that the initial small amount that you invested, the power of compounding will actually, magnify the returns, and it will have a huge effect. As I keep saying, even at the cost of repeating it once again, if you are a taxpayer, start with a tax saving fund. Invest every month, and so that the habit become, you are able to form that habit. If tax saving is not your need, then start with a balanced fund and do that for next 3 years.
Next up, Sanjeev asks if he should sell his property at a 40% loss, which he is currently sitting on, and invest the proceeds in mutual funds because the property market is stagnant.
This is once again a matter of, his own perception and his own understanding. Depends on where the property is. Properties are struggling. Property as an investment is a struggle, and it may not revive quickly, but he is the best person. It also depends on the place where it is, depending on the quality of the property, depending on the likelihood of something coming up in the vicinity which can actually enhance the value. So it entirely depends. But I would say that generally speaking, if your property is an investment, then you should definitely be looking at an opportunity when you can sell it at an appropriate time at a reasonable price. And then in property, your home should not, you should not be buying property as an investment. Uh, 3, 4 reasons why it should not be. One, the ticket size. The other is inconvenience. The third is what you have seen, what you are witnessing right now. Our understanding or historic understanding that property only goes up over a period of time. With small ticket size of investment, I think your equity investment does better with far greater convenience, and you don't even have to worry in between. Uh, Everything is available at, it's entirely dependent on your will. When you want to take your money out, you can. All the money becomes completely tax free. You don't have to worry about maintenance. You don't have to worry about the delivery by the builder. So too many good things going. I think investors should restrict themselves from buying a property as an investment. They should not look at it as an investment.
This next one is from Pankaj. He asks which is riskier, a small cap fund or a thematic fund over 5 to 7 year period.
Uh, they are very different. Some thematic funds are basically a theme. It's not a specific sector. It's not a kind of fund which is investing in a certain capitalization. So if the theme works, it works wonder for you. If you remember, somebody who invested in 2004 or 2005 in the early infrastructure funds, it did wonders for their portfolio. And when the tide turned, the theme actually went out of favor. And unfortunately, the investor behavior is very unfavorable. Investors generally tend to invest in anything which has already gone up, not necessarily when something is going to go up. So anything which is out of favor but it is likely to do very well in future, that theme investors don't really understand. Or it is a very difficult decision to invest. It amounts to buying low and waiting for it to actually gain currency or gain acceptance and then selling high. As compared to that, smaller companies, the story is different. They are small companies, they have small income, they have small profits, and if they are good, they can actually grow faster. Large companies can't grow at the same rate as a small company can, and the growth rate can be higher, so the stock prices actually get gets rewarding. If a company is growing at a 25% annual rate, which a small company can, then it turns out to be extremely rewarding for investors, because the earnings going up by 25%. But for a large company, that gets very difficult. And if a large company can actually do that, then nothing like it. Then it becomes a special opportunity. So I would say that, but at the same time, the downside of small companies is that these companies are vulnerable. Economic downturn or economic cyclicality or something happening, something which happens, which is either regulations or to the market or some such thing, the ability of the small company to withstand an economic shock or a business shock which can happen even from a competition or a aggressive competition or a regulation or a change of weather or change of investor preference or customers preferences. So it can actually have a bearing on that, and we have seen that small companies can wither away, and small companies can potentially grow very fast, or they can be hurt badly. That is why, so what we are witnessing, so they are not comparable situation. If you have a diversified portfolio of small companies, you are likely to do very well over a 10-year period, because because the diversification, all companies will not go wrong, and assuming that the standard rule that some companies will do extremely well, a good number of companies will just be an average performer, or some of them will completely die, then still your money, the company which will do well will actually more than compensate for all the things that can happen, that can compensate for all the bad things that, or average thing that happens to companies in your portfolio. As compared to that, a thematic fund is a big bet on a particular theme, whether it be consumer, whether it be rural India. We have seen many such themes. Infrastructure was one of the most prominent things which investors bought into. Likewise, you would have seen that the consumer, the Gen Next fund that we saw, this theme worked very nicely. So I would say that if themes work, they could be very rewarding. If themes don't work, or if you actually catch a theme at an inappropriate time, it could be very dangerous. Small caps can still do very well over a long period of time. It is not a theme. So this is what you should keep in mind. I think small caps and mid caps should be 20-30% of the portfolio, while I was talking about the cricket connection of your investments. Most thematic funds you can do without, because my understanding of an actively managed fund is that when you are entrusting your money to a multi-cap fund or a large cap fund, the fund manager will take that call.
Thanks, Hiren. That's all we had time for in today's session. Any parting advice for our viewers?
Yes, be excited about the IPL, be excited about your long-term plan, your goal, and the team, as excited as you are about the cricket match.
Thank you, Dhiren.
Thank
And
you.
thanks everyone for joining us. Do join next week as well.